InvestSense market commentary for the second week of July 2025. And most of last week was fairly quiet, a little bit of noise around tariffs and markets a little bit on the back foot, but nothing too serious. Then we had a little bit of a jump on Monday, but overnight the US CPI print has put markets back on the back foot a little bit, especially more cyclical sectors like small companies, Russell 2000 and indeed global small companies. Interestingly, emerging markets solid so far. Gold was pretty strong last week and gave up some of those gains, but still up 1%. It was bond yields where we probably saw the most noteworthy moves, back up to about 4.5% at the 10-year tenor in the US. Now, the proximate cause for that, we've got a chart here from the FT, and what we're showing here is 1 month, where it's quite choppy, 3 months rolling, where it's a little bit more jaggedy, but you can see that little bit of an uptick, and it may be heading in that direction, but the 6 month rolling figure still showing that disinflationary trend. Still showing that disinflationary trend. But the devil's a little bit in the detail. There was, obviously, people are scouring these numbers for evidence of tariff-induced inflation. But if you looked within some of the more import-intensive sectors, like apparel, household goods, manufactured goods like that, you could see signs of inflation. And overall, that meant an uptick to 2.7% on an annualized basis compared to 2.4% last month, which was enough to get people thinking, send yields a little bit higher. And you can see this chart also from the FT shows what the market implied inflation rate is for a year from now. And it's certainly heading up in that direction in a more consistent fashion, getting above 3%. And that also coincides with surveys of consumers and businesses who seem to be seeing potentially an uptick. And that's what you would expect to some extent. At some point, tariffs have got to be allowed for, either at a corporate level with lower profits or in prices to the consumer. Now, the other thing that's been on markets' minds has been the economic growth, and maybe a little bit of a worry creeping in there that you could see that combination of slowing growth. For instance, in Europe, there was some slower data last week, but also Japan, more especially in the producer prices, seeing some deepening signs of deflationary pressures. So the US reporting season is going to be particularly significant, or it might just be noisy like those inflation numbers were. The things to watch out for in this sort of quite noisy chart, I'd focus on the bottom line here where you can see the last 24 at least, some quite positive numbers, all in the sort of teens, if you like, and then maybe a little bit of a slowdown expected. Tariffs probably contributed to this expectation, but still, when you look at the full year 25 number of reasonably high single digits, not too shoddy. But if you look if you zero in a little bit on what's expected for this quarter and for the full year, you can see, again, we've got a lot of polarization and energy earnings expected, given the oil price to be down 25%. Now, that is very much in the price because we know what the oil price is, and there may not be that much variability around that. At the other end of the spectrum, though, you have these highly valued technology and communication services. That's Mag 7, things like Meta, Tesla, Netflix, Google, Microsoft, etc. And expectations are that that continues, and guidance has certainly been pretty strong. Another annualized 30% number expected this quarter, giving you for the full year a highly respectable 15%. When you compare those two numbers, obviously it implies that those earnings are expected to level off quite dramatically in the next 2 quarters to give you an annualized number of 15% for the year. So obviously, so far, tech companies have defied expectations, but there is an expectation in markets that that slows at some point. Now, all of these numbers are, as we say, in the price. So the interesting thing to watch out for if you want to have a horse in this race is with those high expectations, if you see any faltering amongst those tech companies, then you could see some big price moves. Now, obviously, the other thing is going to be in the industrials, maybe amongst pharmaceuticals, and obviously anything involving boosting imports. But the expectation is probably that it's going to be pretty noisy. It's going to be company by company. But over the next few weeks, if you see a pattern emerge, either positive or negative, markets could impute that the global economy is acting accordingly. It'll be certainly one of those reporting seasons where there might be some macro implications and something we'll be following closely. Now, in terms of what we're working on at the moment, we had a conversation this morning with Andrew Hunt about the Australian economy. He's in this hemisphere. He was visiting Australia last year, and he sent us a report last night, which we discussed, and you can get a bit more detail either written or in the video. Now, the overall theme, which we think will resonate with a lot of Australians, is this idea of a two-tier economy, a very financialized economy with a large banking sector. And there's evidence, and this is where Andrew's perspective is particularly interesting, that flows from the US. So monetary ease in the US has flowed into Australia. It's one of the things that supported the share market here, and especially the banks. And it's turned into a bit of a credit boom, which is affecting property markets, especially commercial property markets. But against the backdrop of a real economy, which is maybe creaking at the seams. And that's something that you do hear around the traps, that the real economy is probably a little bit softer than some of the headline numbers would suggest. And then we have a conversation about what he thinks are the implications for productivity, the policy implications, and also the investment implications in the near term and the longer term. And while we finish off this what we're working on section, probably worth addressing the elephant in the room. Obviously, there's a lot going on at InvestSense with the recently announced deal with Beta Shares. Not something we're going to comment on in detail at the moment, but in a few weeks we'll sit down maybe with JT and provide some more detail in this space about what we think the implications are for our clients. But busy times, exciting times. Look forward to talking next week.